After studying this module, you shall be able to know what business risk is and what financial risk is. Learn to calculate the degree of operating, financial and combined leverage. Analyze the impact of changes in EBIT on EPS under different capital structures. A finance manager has to decide how much funds are to be raised and from which source. How much funds depends upon total investment required, and what source depends on what is capital structure. The funds can be raised through equity or debt. Low debt means less risk and less return, whereas high debt means high risk and high return. This is again a question of balancing the risk-return trade-off. To quantify the risk and return of varying capital structure, several techniques can be used by the finance manager. Two such techniques that are widely used are the leverage analysis and the EBIT EPS analysis. When we employ debt in our capital structure, it has to be paid interest at a fixed rate irrespective of what business earns. The balance is available to the equity shareholders, but earnings in business fluctuate over a period of time. Returns from business are uncertain. This is called business risk or operating risk. When EBIT is high, shareholders get good returns, but when EBIT is low, the shareholders might not get anything. The more the debt, the more risk shareholders face. This sensitivity of earnings available to equity shareholders to change in EBIT can be understood using the concept of leverage analysis as well as EBIT EPS analysis. The relationship can be analyzed in terms of the operating leverage and financial leverage. Leverage. Leverage in the general sense means influence of power. That is, utilization of the existing resources to attain something. It is a relationship between two interrelated variables. It shows how a dependent variable changes with changes in independent variable. So, if x is dependent variable and y is the independent variable, then leverage is delta x upon x divided by delta y upon y. Whereas delta x is equal to change in x, delta x upon x is equal to percentage change in x. Delta y is equal to change in y. Delta y upon y equal to percentage change in y. If there are 10 workers in a factory, the independent variable y, the output is 100 units, dependent variable x. If you increase the number of workers to 12, the number of units produced increases to 150 units because of teamwork. Here, delta y is 12 minus 10 equal to 2. Delta x is equal to 150 minus 100 equal to 50. Delta y upon y is equal to 20%. Delta x upon x is equal to 50%. So, the leverage in this case is equal to 50% divided by 20% is equal to 2.5. This implies that with 1% increase in labor force, the output increases by 2.5%. Operating leverage. In simple words, operating leverage means influencing or using the power of operations. It means producing more units to increase sales. Since fixed costs remain same, more units will generate more EBIT. The EBIT will be greater within the proportional increase. Sales minus variable cost is equal to contribution. So contribution is proportional to sales. As increase in sales will create corresponding increase in variable cost. So contribution minus fixed cost is equal to EBIT. Any increase in contribution will cause a corresponding increase in EBIT. But EBIT being a lesser amount than contribution, as it is reached after deducting fixed expenses from the contribution, the percentage increase in EBIT will be more than percentage increase in contribution, as fixed costs remain same. Operating leverage is equal to percentage change in EBIT divided by percentage change in sales. A sale is the independent variable and EBIT is the dependent variable. Illustration 1. Sales is equal to 5,000 units. Selling price SP per unit rupees 20. Variable cost VC per unit is 15. Contribution per unit 5. Fixed cost 20,000. If we look in the table, sales 5,000 into 20, 1 lakh, minus variable cost 5,000 into 15, 75,000. The contribution is 25,000. The fixed cost is 20,000. So EBIT is 5,000. Now if sales increases to 6,000, then sales will be 6,000 into 20, 1,20,000, minus variable cost 6,000 into 15, 90,000, contribution is 30,000, minus fixed cost 20,000, so EBIT 10,000. Delta EBIT is equal to 10,000 minus 5,000 is equal to rupees 5,000. Percentage increase in EBIT is equal to 5,000 divided by 5,000 is equal to 100%. Delta sales 20,000 and percentage change in sale is 20,000 divided by 1 lakh, 20%. So operating leverage in this case is 100 divided by 20 is equal to 5. This implies that any change in sales at 5,000 units will give 5 times change in EBIT. This is also called the degree of operating leverage or DOL. Degree of operating leverage is equal to contribution divided by EBIT is equal to 25,000 divided by 5,000 is equal to 5. At sales level of 6,000 unit, DOL is equal to contribution divided by EBIT is equal to 30,000 divided by 10,000 is equal to 3. So now if sales increase from 6,000 unit, any percentage change in sales will result in 3 times percentage change in EBIT. Illustration 2. Calculate the DOL for XYZ Limited given the following information. Quantity produced 5,000 units, selling price per unit 500, variable cost per unit 200, fixed cost 9 lakhs. Solution. Sales 5,000 into 500 25 lakhs, minus variable cost 5,000 into 200 10 lakhs, contribution is 15 lakhs, minus fixed cost 9 lakhs, EBIT is 6 lakhs. So DOL is equal to contribution divided by EBIT, which is 15 lakhs divided by 6 lakhs is equal to 2.5. One can find the DOL for XYZ Limited. Now you see the different level of units produced. And what you observe, for quantity produced at 1000, 2000, 3000, 4000, 5000 units, the DOL is minus 0.5, minus 2.0, infinite, 4.0, 2.5. We see when contribution is exactly equal to fixed cost at 3000 units, the DOL is undefined. Here, EBIT is 0. This is also called operating break-even point. Significance of operating leverage. It measures business risk. We know that the higher DOL means more sensitive is EBIT to a given change in unit sales. There is a greater risk also. A slight decrease in sales might erode the EBIT of the firm. Therefore, firm should avoid operating at high degree of operating leverage. Production planning. A firm may also go for production planning if sales are expected to be high. Investing in fixed costs to reduce variable cost will decrease DOL and will result in increased EBIT. Financial leverage. Financial leverage measures the relationship between EBIT and EPS. Here, EBIT is the independent variable and EPS is the dependent variable. Financial leverage measures the sensitivity of EPS to change in EBIT. Financial leverage is equal to percentage change in EPS divided by percentage change in EBIT. Financial leverage is due to the fact that no matter what the EBIT, the interest cost will remain same. So if EBIT increases, EPS will increase more than EBIT as interest costs are same. EPS is profit after tax divided by number of shares. Illustration 3. X Limited has an EBIT of rupees 10,000 with an interest cost of rupees 5,000. Tax rate is 40% and number of shares are 300. What will happen to EPS if EBIT increases to 15,000? And what will be financial leverage? Solution. EBIT 10,000, interest cost 5,000, profit before tax 5,000, minus tax 2,000, PAT at 3,000, number of shares 300. So the earning per share is equal to 3,000 divided by 310. If EBIT is 15,000, then EBIT 15,000, interest cost 5,000, PBT 10,000, minus tax 4,000, PAT 6,000, number of shares 300, EPS is 6,000 divided by 300, 20 rupees. So delta EPS is equal to 20 minus 10, 10. So percentage change in EPS is 10 divided by 10 into 100 is 100%. While change in EBIT, delta EBIT is 15,000 minus 10,000 is 5,000. Percentage change in EBIT is 5,000 divided by 10,000 into 100 is 50%. So the financial leverage is equal to percentage change in EPS divided by percentage change in EBIT, which is equal to 100% divided by 50% equal to 2. It implies that for a given percentage change in EBIT, EPS will show twice the percentage increase. Thus, if a firm wants to increase EPS by 50%, it should attempt to increase EBIT by half, that is 25%. 2 is also the degree of financial leverage. Degree of financial leverage, DFL, is EBIT divided by PBT. So when EBIT was rupees 10,000, DFL was 10,000 divided by 5,002. When EBIT is 15,000, the DFL changes to EBIT upon PBT is equal to 15,000 divided by 10,000 is equal to 1.5. At this level, EPS will increase 1.5 times the increase in EBIT. If there is no debt in the capital structure, DFL is equal to 1. Illustration 4. Show that when interest cost is nil, the degree of financial leverage will be 1. Use EBIT rupees 10,000 and rupees 15,000. Solution 4. Now look at the table. We start with the EBIT 10,000, 15,000. Interest cost nil, nil. PBT 10,000, 15,000. Minus tax at 40%, 4,000, 6,000. PAT 6,000, 9,000. Number of shares 300, 300. EPS is 20 and 30. Now you will observe percentage change in EBIT is 50% and percentage change in EPS is 50%. So the DFL is 50 by 50 equal to 1. If EBIT is equal to interest, then EPS is 0. At this point, financial leverage is undefined and this is also called financial break-even point. Financial leverage will be favorable only if rate of return on investment is greater than cost of debt. If ROI is less than cost of debt, financial leverage will be unfavorable. If ROI is exactly equal to cost of debt, additional debt will not generate any excess return to the shareholders. Combined leverage. Combined leverage is product of financial leverage and operating leverage. It is given by percentage change in EPS divided by percentage change in sales, or it can also be contribution divided by EBT. Illustration 5. Calculate the degree of operating leverage DOL, degree of financial leverage DFL and degree of combined leverage DCL for the following firms. In the table you see two firms. Output is 6,000, 10,000. Sale price 50 paisa, 20 paisa. Variable cost 20 paisa, 15 paisa. Fixed cost 700, 150. Interest cost 400, 300. Tax 40%. Number of shares are 800, 800. Now solution. You see the output is 6,000, 10,000. Sale price per unit 0.50, 0.20. Variable cost per unit 0.20, 0.15. Contribution per unit 0.30 and 0.05. Total contribution 1800 and in the above case it is 500. Fixed cost 700, 150. EBIT 1800 minus 700, 1100. 500 minus 150, 350. Interest cost is 400 and 200. Profit before tax 700 and 150. Tax at 40%, 280 and 60. Profit after tax 420 divided by 30. Degree of operating leverage is equal to contribution divided by EBIT. For firm A, it is 1800 divided by 1100, 1.636. Firm B, 500 divided by 350, 1.428. Degree of financial leverage is equal to EBIT upon PBT. For firm A, 1100 divided by 700 is equal to 1.571. Firm B is equal to 350 divided by 150 is equal to 2.333. DCL is equal to DOL into DFL, which can be written as contribution divided by EBIT multiplied by EBIT divided by PBT, which in this case boils down to contribution divided by PBT. So form A is equal to 1800 divided by 700 is equal to 2.571, and form B is equal to 500 divided by 150 is equal to 3.333. EBIT EPS analysis. The return available to the shareholders can also be analyzed at a particular level of EBIT, within bracket earnings before interest and tax, under different conditions of financing. In analysis of the effect of different patterns of financing or financial leverage on the level of returns available to the shareholders under different level of EBIT is known as EBIT EPS analysis. Illustration 6. Let's take a company which requires capital of 10 lakhs. Its return on capital is A, 20% per annum, therefore its EBIT is 2 lakhs. B, 15% per annum, therefore its EBIT is 1,50,000. Let's further assume that it raised capital by borrowing at 10% per annum and balance in the form of share capital of rupees 10 each. What will be the EPS, earning per share, if it borrows 1, rupees 4 lakhs, number 2, rupees 5 lakhs, the tax rate is 30%. Solution 6, A1. Total capital required 10 lakhs, loan amount 4 lakhs, amount to be raised through equity 6 lakhs, therefore number of shares 6 lakhs divided by 10 is equal to 60,000 shares, and share capital is 6 lakhs. Particulars: EBIT 2 lakhs minus interest at 10% on 4 lakhs 40,000, profit before tax 1,60,000 minus tax at the rate of 30% 48,000, profit after tax 1,12,000, EPS is 1,12,000 divided by 60,000 is equal to rupees 1.866. A2. When share issued are 50,000 and loan amount is 5 lakhs. The company had raised 5 lakhs through borrowing and rest by issuing 50,000 shares of rupees 10 each. EPS when EBIT is A2 rupees 2 lakhs. You see the table? EBIT 2 lakhs minus interest 50,000, PBT 1,50,000 minus tax 45,000, profit after tax 1,05,000, EPS 1,05,000 divided by 50,000 2.1. In the second situation, when EBIT is 1,50,000. So let's consider the situation B1. Here EBIT 1,50,000 minus interest on 4 lakhs 40,000, PBT 1,10,000 minus tax 33,000, profit after tax 77,000. So EPS is 77,000 divided by 60,000 as 1.283. B2. EBIT 1,50,000, interest on 5 lakhs 50,000, PBT 1 lakh, tax on this 30,000, profit after tax 70,000, and earning per share 70,000 divided by 50,000 is 1.4. Thus we see how EPS changes with changes in level of borrowings and with change in EBIT. A firm has various options regarding the combination of various sources to finance its investments. The firm can go for all equity, or it may use borrowed funds. It may also use preference share capital as a source of fund. Different mixes of the two or three of them will give different return to the equity share capital. Thus, an interaction between the varying level of EBIT and different financing patterns can affect the EPS in many ways. In this chapter, we will study the impact of various combinations of financing on the EPS, keeping EBIT constant and then with change in EBIT. This is termed as EBIT EPS analysis. Illustration 7. Let's take another example where a firm needs 10 lakhs as capital. This money can be raised in the form of equity or preference share capital or debt. Preference share capital costs 12% per annum and the cost of debt is 10%. Rate of return on investment is 18% and 15%. Tax rate is 30%. The firm has following option to raise finance. Option 1, all equity. Option 2, 50% equity and 50% debt. Option 3, 50% equity and 50% preference share capital. Option 4, 50% equity, 30% debt and 20% preference share capital. Solution 7. EPS under various options and find the reasons for changes in the EPS. Now, if you look at the table, it has shown you the pattern of EPS or EPS calculation under different scenario. To start with, EBIT is assumed at 1,80,000. Interest is at 10% and we can calculate PBT. Only in the second and fourth situation there is interest payable because company is taking loans. We can deduct tax from there. We will get the figure of profit after tax, which you can see in the four situations. From there, we will deduct the preferred dividend and then we will get profit which is available to equity shareholders. Number of shares in each situation is given and we can calculate EPS, which in the fourth situation is 1.26, 1.82, 1.32, 1.62. In the same example, if we simply change EBIT from 18% to 15% and check the EPS for the same four options, our results would be as follows. EPS under various options and find the reason for changes in EPS. We can straight away come for the EPS calculation in this table under the fourth situation when EBIT has changed, and you observe that all equity finance EPS is 1.05, with debt financing 1.68, with preferred financing 0.90, and with 50, 30, 20 situation it is 1.20. Indifference point or level. The indifference level of EBIT is that at which EPS remains same under two or more capital structure. So it is gathered that when ROI is exactly equal to the cost of debt, the EPS would remain same under different level of debt in capital structure. Such level of EBIT at which the firm has two or more financial plans resulting in same level of EPS is known as indifference level of EBIT. Illustration 8. A firm requires funds of rupees 5 lakhs for expansion. It can raise shares at 250 per share or may borrow 5 lakhs at 20% rate of interest. After the new investment, the EBIT of the firm would be 6 lakhs. The company has already issued 10,000 number of shares. Now it has two alternatives. issue 2000 shares at 250 per share and raise the money needed for expansion, or borrow 5 lakhs at 20% rate of return. The EPS under two alternatives is calculated as under, and you can observe through the different calculations that EPS is coming to 25 in both the scenario. Thus, the firm, if it attains an EBIT of 6 lakhs, it would be indifferent towards the manner it raises the money. It is giving earning yield of 10%, which is same as after tax cost of debt. Earning yield is defined as EPS upon market price into 100, which is 25 divided by 250 into 100 is equal to 10%. Cost of debt after tax is 20%, multiplied by 1 minus 0.5 is equal to 10%. So at that level of EBIT, which is same as cost of debt, it would be an indifference point as it is same level of EPS under any amount of debt. But if the EBIT falls from 6 lakhs, the EPS will be higher for unlevered firm, and when EBIT increases from 6 lakhs to a higher figure, the EPS of levered firm will be higher. The same can also be explained graphically, which you can see. That blue line is showing advantage of debt and a break-even EBIT is considered. So at a break-even point, the two capital structures are giving the same EPS, and this graph is self-clear. The point at which plotted lines of different EBIT, EPS values intersect when shown graphically is called the EBIT indifference point. This value of EBIT produces the same value of EPS for alternative financial plans. If the firm expects to generate exactly the same amount of EBIT at which EBIT, EPS lines intersect, then from point of view of profitability, the firm would be indifferent between the choices of capital structure because the same EPS would result from either of the alternatives. The same can also be calculated by formulating an equation. Plan 1, number of shares 12,000. Plan 2, number of shares 10,000. Interest cost 1 lakh. The equation used here is EBIT minus interest multiplied by 1 minus tax rate divided by number of shares in plan 1. This should be equal to EBIT minus interest multiplied by 1 minus T divided by number of shares in plan 2. Now substituting the values in the formula, we get EBIT is equal to 6,000, or an indifferent level of EBIT is 6,000 for determining the capital structure. A finance manager has to decide how much funds are to be raised and from which source. The funds can be raised through equity or debt. Low debt means less risk and less return, whereas high debt means high risk and high return. This is again a question of balancing the risk-return trade-off. To quantify the risk and return of varying capital structure, several techniques can be used by the finance manager. Two such techniques that are widely used are the leverage analysis and the EBIT EPS analysis. Leverage in the general sense means influence of power, that is, utilization the existing resources to attain something. In simple words, operating leverage means influencing or using the power of operations. Operating leverage is equal to percentage change in EBIT divided by percentage change in sales. Financial leverage measures the relationship between EBIT and EPS. Here, EBIT is the independent variable and EPS is the dependent variable. Financial leverage measures the sensitivity of EPS to changes in EBIT. Financial leverage is equal to percentage change in EPS divided by percentage change in EBIT. Degree of financial leverage can be calculated as EBIT divided by PBT. Combined leverage is the product of financial leverage and operating leverage. It is given by percentage change in EPS divided by percentage change in sales, or it can also be contribution divided by EBIT.